My name's Dave Dubeau, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey folks, welcome back. Chances are, if you've hung around our world for any length of time, you've probably heard me talk about raising capital. You've heard me interview a bunch of people that are really good at raising private capital, but you might not have heard very much about crowdfunding, at least not on this podcast up until now. Well, that's going to change, because today we have a crowdfunding expert. Mark Roderick is zooming in from just outside of Philadelphia, and Mark is very, very passionate about crowdfunding as a way of leveling the playing field. So, Mark, welcome to the show.
Thank you very much. It's a pleasure, and I appreciate being invited.
So, Mark, let's pretend I've been living under a rock for the last 20 years and don't have the faintest clue of what crowdfunding is. Can you give us an explanation that an average, not so smart 13-year-old would understand?
You're describing me perfectly, so I should be able to. Well, first, get out from under the rock, shake off the dirt, have something to eat.
Okay.
Crowdfunding, in its widest sense, is just using the internet for yet another thing, and that thing is raising capital. The internet, we use it almost. This used to sound meaningful when I used to say it years ago, but now it's just become so baked in for all of us. But we use the internet for everything, right?
Yeah.
We book vacations, we find romantic partners, we renew our vehicle registration. We use the internet for everything. But before the Jobs Act, that's what the law was called, signed by President Obama in 2012, one thing every securities lawyer would tell you is you cannot use the internet to raise money. Illegal, impossible, go to jail. The Jobs Act changed that, and it created a number of cubbyholes, we can think of them, exemptions from the Securities Act. But we can think of them as little cubbyholes. A number of ways that you could and can now use the internet to raise money for your project. So, there were several types of crowdfunding, and I don't know how much you want me to go into the weeds about that.
Not in the weeds, just big broad strokes for right now.
Big broad strokes. Okay. I'll go from the, I can't really say go from the smallest to the largest, but the smallest is definitely what we call these days, we call Reg CF. And that's what you see being done on big platforms like WeFunder and Start Engine, and on much smaller but wonderful real estate only platforms like Small Change. And that is a highly regulated cubbyhole where you are limited to how much you can raise each year. You are limited in how much non-accredited investors can invest. Lots of regulation around protecting non-accredited investors, but you can do it online, and that would have been unheard of before the Jobs Act.
Okay.
The second kind, which has been fantastically successful in the real estate world, is what we call Rule 506C. Now, guess which SEC rule that comes from? Rule 506C.
Yeah.
And that allows unlimited advertising, by billboards or airplanes flying with banners at the shore. You can do anything as long as all your investors are accredited. And yeah, that has been super fantastically successful, billions of dollars raised for real estate projects that way. It didn't used to be legal. And then the third, it is Regulation A, which is another set of SEC rules. A Regulation A offering is like a mini public offering. So it takes longer, more expensive from the regulatory point of view.
Yeah.
But you can raise up to $75 million a year from both accredited and non-accredited investors. So these are all, different flavors of crowdfunding, and different flavors are appropriate for different projects, but all new and all made possible by the Jobs Act.
Very cool. All right. Well, thanks for giving us the overview there. What size of a project or a deal is kind of like the minimum viable size where this is, in your experience, a worthwhile endeavor?
Well, surprisingly small. So before the Jobs Act, before there was crowdfunding, there were still rules.
Yeah.
They were very strict rules. And the cost of complying with those rules was, in many cases, higher than the cost of complying with the crowdfunding rules. So, back then, you had a project you were only trying to raise $500,000 for, you went to a lawyer like me, and they would say, it's not worth it. It's too expensive to comply. Today, you can take that $500,000 deal to a funding portal. These are regulated entities that operate within Reg CF, and they will gladly try to raise the money for you using Reg CF. So maybe I would say, that's a threshold. You're trying to raise less than $500,000. I don't know if it's worth it at all,
Yeah.
And there may be other financing available, borrow money or something. So let's just say, for the heck of it, trying a dart, $500,000. Now, Regulation A is a different story. It's more expensive, time consuming. So maybe you'd say $5 million for Regulation A. But yeah, for both Reg CF and 506C, which is the accredited only flavor, yeah, 500,000 could make sense.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com. So in your experience, Mark, let's say you're working with a new client who hasn't done crowdfunding before. They've raised capital other ways through traditional syndication or, focusing on their existing network. What do you see as working best for folks to get this rolling? Because not even though crowdfunding's been around for a while, not everybody's doing it. It doesn't seem to be working like gangbusters for everybody. There must be certain deals or certain kinds of people this tends to work better for. What have you seen in your experience?
It is actually, it opens the playing field for pretty much everyone. So it actually works for anybody trying to raise capital. it likely reduces the cost of capital and increases the ability to raise capital. So, for example, you have a sponsor who has always relied on a handful of people she knows to write checks for her projects. Often, those folks are accredited. It doesn't take a lot to be accredited these days. It takes 200,000 of income and $1 million of net worth. I'm not being facetious about it, but those numbers, the raw numbers, are identical to what they were in 1982. So,
so adjusted for inflation, it'd be quite a bit different today.
It's quite a bit different. Yeah. But so $200,000 is or $1 million of net worth is very probable, at least, that if a sponsor has a group of folks who have been investing in their deals, they're probably accredited already.
Yeah.
And I would tell her, okay, great, you can invite those same people to participate, but now you can have a website and invite the whole world at no additional cost. So I can't tell you how many real estate sponsors like that I have represented. It just is a way to vastly expand your capital network. That's Rule 506C, you will note, and that's the one I told you has been so successful. Reg CF and Regulation A have been much less successful for typical real estate sponsors.
Why is that?
Reg CF, because of a couple reasons. And one, the only reason to use Reg CF or Regulation A is you want to raise money from non-accredited investors. Because if you want to raise money from accredited investors, just use Rule 506C, faster, cheaper, cleaner, easier. So you want to raise money from non-accredited investors, for example, and I've invested in handled multiple of these deals. You're the sponsor. Your project is urban infill, sort of, neighborhood improvement kinds of things. You're going to put up a mixed residential retail thing in a neighborhood that hasn't been so great. So you're really contributing to the neighborhood. And you want to give residents of the neighborhood the opportunity to participate in your project, which can have benefits both ways. Maybe if they invest, then they'll patronize the retail stores and things like that.
Right.
So Reg CF should be perfect. But Reg CF, as I said, is highly regulated and comes with a lot of limits. So the amount of money that each non-accredited investor is allowed to invest is very low.
Yeah, how much?
A few $1,000s for most people.
Yeah.
And so let's say you're trying to raise $3 million and you'd like $500,000 of it to come from the neighborhood, from non-accredited investors. You've got to attract a lot of investors. The non-accredited investors get up to that $500,000.
A couple of hundred of them. Yeah.
Yeah. And that's hard.
Yeah.
It's so much easier to say, forget it. We'll just get another $250,000 check from an accredited investor. So,
right.
And then, as I said, or I kind of implied, Reg CF happens only through these new regulated entities called funding portals. And unfortunately, but understandably, given the economics, the large funding portals have adopted practices that in my mind, to put it sort of rhetorically, no serious investor would ever invest. So because of the practices these funding portals have adopted. And so
So if I'm reading between the lines, then you might be able to get some non-accredited investors to invest through that portal, but accredited investors are not, it's not going to be appealing to them at all. And it's horrendously difficult to get enough non-accredited investors for it to be worthwhile. And that can only make up a small portion of the total amount that you're allowed to raise.
Yeah.
Am I getting that?
You got it perfectly.
Okay. Yeah. Okay. I could see that being a challenge. Yeah.
So they're just, both because of the regulatory framework, which was of course adopted to try to protect non-accredited folks, widows and orphans, protect them from people like you and me.
Yeah.
They have the side effect, no good deed goes unpunished. They have the side effect of making sure there are no good deals in the space.
Well, I mean, that was kind of the sales pitch for crowdfunding originally was, hey, now you can raise capital from moms and pops and you can give them the opportunity to get into real estate for a couple of $1,000 and yada yada. But it sounds like that's kind of backfired. It's not working.
To a large degree, it has.
Yeah.
So
it's still great for accredited investors, but it's not really helping the mom and pops.
It is really not helping mom and pops much. I mean, the volumes are low. The number of deals, I think, fell year to year from 2024 to 2025. So it's, and I'm talking about Reg CF specifically. I think, yeah, it's an industry that is not prospering, which is sad for those of us who were, really evangelical about it.
Yeah.
In the beginning. But who knows if the funding portals start behaving better, then better issuers, better companies will try to raise money there, and then investors will come. And so who knows, it's still kind of the early days of.
Yeah. So if I'm understanding, Mark, then crowdfunding today, the way that tends to be working best is allowing us to use this to advertise our deals to accredited investors. That's the big shift. That has been the big change. But it's the big change.
And just to be clear, and because I'm a lawyer, you can advertise to everyone. You can advertise to the whole world.
But they have to be an accredited investor to invest.
They have to, exactly. Yeah. You can't accept the money without verifying that they are accredited. And of course, this has different effects depending on which part of the country you live in. I mean, one of the great promises of Reg CF was that it would no longer matter where you lived. You could use the internet to attract investors from the entire universe. And that is theoretically true. However, Rule 506C, allowing only accredited investors, there are a lot, if you looked at a map, colored map showing concentration of accredited investors.
Yeah.
I think you and all your listeners can guess what that map would look like.
Yeah, a lot of stuff on the coast.
A lot of stuff on the coast. Yeah. And then Chicago.
Yeah, big cities.
So in Middle America, real estate deals get funded by non-accredited investors. And so Rule 506C is not helping those regions as much as it is helping the more affluent coastal areas.
Got it. No, well, Mark, thank you very much for kind of explaining a little bit about this, the history of this, how it really works versus how it was pitched to everybody back in the day. I'm sure there's going to be people interested in finding out more. I know that you've got a very, very popular blog all about this. So if people want to check out your blog and maybe connect with you, what's the best way for them to do that?
To go to my blog, and there's contact information there. The blog is crowdfundingattorney.com. That's pretty simple to remember, or just type my name, Mark Roderick, crowdfunding, and you'll get there also. But crowdfundingattorney.com.
Fantastic. Mark, thanks so much for being on the show. It's been a pleasure getting to know you.
Thank you so much.
All right, everybody, take care, and we'll see you on the next one. Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.